Hello, and welcome to Credibly Challenged. My name is Matt Bisanz, and I'm a bank regulatory partner with the law firm of Mayer Brown. This podcast is devoted to bank risk management and related innovation issues that confront many of my clients and contacts in the financial services sector. I'm honored today to be joined by Bryan Mulcahey of FS Vector. He is a managing partner of the firm who advises fintech companies, tech companies, and banks on their business and regulatory issues. Bryan, thank you for joining us today.
Thanks for having me. Excited to be here.
So one thing that was the original reason I think we got in touch was your work on the Connecticut uninsured or non-insured bank charter that your firm has been quite active. And recently there has been some success with at least, I think, one of their banks getting approved for some federal benefits, some approved at the state level, and then some others in progress. So maybe for our listeners who aren't as familiar with it, can you tell us a little bit about why there is an uninsured bank charter in Connecticut?
Yeah, it's really interesting actually. So the Connecticut regulators have a uninsured bank charter. They it's actually been pretty inactive over the past, I don't know, 10 or 15 years. But recently we've seen quite a bit more interest in it, and I think Connecticut has been out there recruiting companies to apply. I think they really have an interest in serving as the regulator for this type of activity. And I think sometimes we forget like the OCC and the FDIC and the Fed, like they have to really want to be the regulator of these institutions, and that plays a significant role in whether they approve a de novo charter or kind of if they express to
Mhm.
someone during a pre-filing meeting whether they're actually interested in it. And I think Connecticut is kind of part of their kind of focus on innovation and trying to build a bit more of a tech corridor um, up there in eastern Connecticut. They they thought it may be a really good way to attract some innovative companies to Connecticut. And so over the past several years, we've seen an uptick in companies applying and several being granted the charter, and as you mentioned, one being granted a Fed Master account. But I think a lot of it has to do with the state wanting these companies to be in Connecticut. They will open an office in Hartford, and they will, build a team there, and they will kind of recruit people from their company to move to Connecticut. And so, it's part of Connecticut's strategy for kind of building a stronger financial economy, financial services economy up there.
Yeah, I think a lot of people forget that the state banking regulators were for a long time or were the first and for a long time the only game in town as far as bank charters. That the OCC wasn't created until the 1860s, the Fed wasn't created until 1913, and the FDIC dates to the Great Depression. And so while they may be the dominant news stories today, particularly the Fed with its monetary policy role, the state banking regulators have been around much longer, that there are banks in New York who date back to the 1700s. Um, and while for you and me and probably all of the listeners on here, we do our banking at an insured bank, there is really no law, no federal law that says a bank must have deposit insurance. There may be state laws, like in New York, there are certain laws saying unless you have an exemption, you have to have deposit insurance. But then there are states like Idaho who are just silent on it. And I think that people forget that there are certain uninsured banks. There's one very notable, well-known investment bank in New York that's actually a deposit-taking uninsured bank. There's a handful in Vermont and Maine that I learned about when FinCEN implemented its non-federally regulated AML requirements, and it cited in a footnote there are 12 uninsured banks who we think this will pick up. And then, as you mentioned, there was the one for a while in Connecticut, and now it looks like there will be more. But as long as the state regulator is okay with it and it's permissible under state law, there's really no requirement to be federally regulated.
Yeah, what's interesting is we actually come across this conversation with a lot of our fintech clients, not just when they're thinking about a charter, but when they're thinking about setting up an FBO program for payments activity, right? That a lot of times they ask us like, oh, how do we make sure that this is FDIC insured? Or in the conversation is often, do your clients desire for this to be FDIC insured? Do they need this to be FDIC insured? Like, are these funds actually at risk somehow? Depending on the kind of payments infrastructure. And I think a lot of the novel charters are targeting actually a client base or a fintech to apply that has customers who really just don't expect or need FDIC insurance, right? So the past two Connecticut charters that have been, one's been approved, one just had a hearing the other day, were physical banknote companies.
Right.
The one before that was a Banking Circle was a commercial payments business for international transactions, where they really just didn't believe that their customers cared much at all about FDIC insurance, just like given the flow of funds and the structure and the use case. And there are a lot of pieces, maybe not the full banking suite, but a lot of pieces of banking and money movement that doesn't have that expectation or even need for FDIC insurance. And if you don't need it, you might as well not have it, right? And
Right.
unless you like why avail yourself of that oversight and having to go through an FDIC approval process the way companies, even like ILCs, have to go through it if you don't need it.
Right.
So it's really
And I think
interesting.
foreign banks have learned that lesson after the issues in the early 90s and after FIBC, when they were no longer able to get insured branches. And so almost all except maybe 10 foreign bank branches in the US are uninsured. And some of them, like the Japanese banks, have over 100 billion in deposits. And they are really almost full service banks, that they do commercial loans, they do cash management, they do payments, and some even do clearing activities, and it's all for commercial customers. So they're not taking any of your or my deposits. But if you're one of those big multinationals out there and you need to keep $1 billion float handy in the US for your vendors, you kind of know that's not going to be insured. There's just no way you could ever spread it around to get insurance coverage given the $250,000 maximum. So yeah, why not put it in an uninsured branch, or in your case, an uninsured bank?
Yeah, yeah.
Yeah.
I think there's definitely some concern from some groups out there about having more uninsured banks, right? But
Mhm.
and there needs to be, and I know Connecticut has been working on this as well, kind of an education campaign with the Fed and with folks in DC about the need for these charters, why they don't add some level of kind of risk to the financial ecosystem, or some additional risk. And I think we also I guess the Maltby charter can be insured.
Mhm.
Doesn't necessarily. I don't even think that the companies that are seeking that charter are planning to seek FDIC insurance, but I guess
Mhm.
it is available to them,
Mhm.
which is helpful for other reasons that we can get into later. But
Yeah.
um, yeah, the
Yeah.
oh, go ahead.
So while we've been talking about how great it is to be able to get these uninsured charters from states, there are only a handful of them, and I mean, historically, states pushed banks to obtain FDIC insurance, but I think one of the other factors was to be plugged into the national financial system. There are some unavoidable federal touch points that if you want a Fed master account, the only person who can give that to you is the Federal Reserve. Um, and so that's kind of an unavoidable federal touch point. And I think you start to run into that with some of the private sector actors who have patterned themselves on after a governmental organization. So like when you think of things like the clearinghouse or the payment system networks or the credit card networks, while they aren't federal entities, they kind of have a scope of federal entities because most payment networks now are national in scope. And at least in the US, they've always been for insured depository institutions. But I think maybe in some ways that's changing, or you're trying to help that change.
Yeah, a little bit. I think maybe we should just chat real quick about the way the Connecticut charter interacts with the Fed. So you don't you would typically tell Connecticut, oh, we will also seek a Fed master account upon receiving some kind of preliminary approval for this charter. Sometimes they will condition the approval on obtaining a Fed master account. I think in a few situations they've said we will grant the full charter and allow you to operate essentially through like a correspondent or a banker's bank. But most of these businesses tend to really, the business model really only works should they obtain a Fed master account. And I think that's the really tricky part here, which is the Fed hasn't necessarily been open or incredibly receptive to these applications. And we did see one. It was a physical bank notes. This is the one that was backed by Randall Quarles. And I think that it's nice that opens the door and starts a conversation about granting master accounts for these charters. But we need to see much more movement from the Fed before I think these novel charters, specifically the Connecticut one, really takes off.
Yeah, because the Fed's concern, obviously, beyond just the is it a good idea, is its own safety and soundness that you probably know about when Silicon Valley Bank failed, that part of the reason it failed was it had a massive overdraw on its Fed account on that Friday morning, something like $900 million because it just couldn't get the collateral and other things in place quickly enough. And while that was a federally regulated bank, that I think is some of the Fed's fear of, well, if we have banks who we really don't have good visibility into, who we are letting do large transactions like that, like the bank you're referring to there, or like some of the other ones who have had access, like say the Puerto Rican international banks, that they're not going to have a $900 million intraday overdraft. Like that's just not their business model. But if you just opened the door wildly to anything, that yes, you could end up in that kind of position, and it ultimately the Federal Reserve is on the hook for those overdrafts.
Yeah, yeah.
Yeah.
And I think one of the things, as I mentioned earlier, is that the Federal Reserve is doing is they're looking at these charters and they're thinking hard about, does the banking system in the US really need this charter to exist or this company to exist? And I think with the example of the physical banknotes, they really do. Like the big banks don't necessarily want to be in that business anymore. Somebody needs to do it. And this company has proposed and has a nice business model around how they would make it work and how they would kind of take that activity on so that the big banks don't have to do it, as the big banks try to kind of get rid of some of these business lines, like they've always been trying to get rid of embassy banking, right? Like there's certain things that they have to, that the Fed forces them to do because we need someone to do it that they don't really want to do anymore. So I think that's if I was starting a company and kind of thinking about how to utilize a charter, I'd probably start by looking at like, what do the big banks do that they don't want to do anymore? But the Fed really needs to make sure someone provides that service going forward.
I think it also really helped, at least in that first bank, that it had highly credible ownership and management, that it had people who were very familiar with how the U.S. banking industry works. They were somewhat restrained. That I remember once I was at a speech by the OCC, and they said, like, look, they were talking about the sanctity of the charter, and I think maybe they overdo that a little bit, but they're like, it terrifies us when a new applicant comes in and is like, well, we've got a 3-year runway of funds, and then after that, we'll see if we'll stay in the business. And they're like, we do not want to be chartering banks that might run out of money after 3 years because it's just a moonshot if they'll stay in business. That's not how a banking system works when it particularly has not only the public interest but also a vital support of the financial system. And so having that kind of really credible ownership and management who is like, look, we've worked in banking, we are going to do what is, as you described, a very boring activity of moving physical banknotes. Like you would be hard pressed to sell that in Silicon Valley if you showed up in some VC's office and you're like, I have this great idea for a new startup. We're going to dominate the market because no one wants to do this. It is trucking around paper. Like that's just going to be a killer pitch in Silicon Valley. But that's the kind of thing that really appeals to regulators when they're like, look, we have to worry about the whole financial system.
Yeah, for sure.
Now, Connecticut, the one bank was able to obtain a Fed master account. But maybe let's pivot to talk a little bit about the Georgia uninsured bank charter, because that has kind of a different purpose to it, that its purpose really is to provide access to some of the private payment networks like the credit card systems. And while there was, I heard, one granted back in 2012, one of the concerns with it has been that, much like the federal government, there's no way to make sure a credit card network or private payment network will grant access to a Georgia uninsured bank. Can you tell me a little bit about how that thinking has evolved?
Yeah, well, I think there's a lot of pressure on the card networks to be very, very careful about what they do with the power that they have, right? We see a lot of cases right now around interchange, and there's the DOJ case involving Visa. And I actually think this plays well into the charter applicants' hands, right? Because they are essentially going to the card networks right now asking to be let in. And, they're all big, serious companies, right? These are not early stage startups that don't have significant card volume and don't have a really good argument that they should be allowed in. Also, the charter that they have, right, specifically is eligible for FDIC insurance. There's you can kind of squint at that
Yes.
and wonder whether or not that's actually, yes, that's why Georgia included it. No one's ever actually, I think, applied for FDIC insurance with that charter. In fact, I don't think any entity actually holds the charter outside of Fiserv. So I think the question is, would it be a really good idea right now for the card networks to say no? And I think there's just a lot of pressure on the card networks right now, and I think that's probably the best time to try to go for while they're under quite a bit of scrutiny around how they've kind of managed their power and their network over the past 10 years.
And so we've been talking about how uninsured banks, depending on the business model, may have a cost advantage or a cost savings, that if you're not going to take retail deposits, why pay FDIC insurance assessments? If your customers don't want deposit insurance, why pay FDIC deposit insurance assessments, which are an annual fee that is quite material for many banks? But state banking charters are not free. That Georgia, Connecticut, they do require their uninsured banks to be well capitalized. They do require robust compliance and risk management systems. There is the whole supervisory process that adds a layer of cost to it. And so I think probably for some of our listeners, particularly those in the fintech sector, they either can never or never want to be a bank. They will always be a non-bank. And if anything, there are probably more of those out there who have committed to a life of non-bankhood than there are people who would be interested in this uninsured bank charter. Um, you recently established a coalition that's really targeted at that sector. And I have to admit, I do some consumer work with my partners in the Consumer Financial Services Group, but can you tell me a little bit more about like what the audience is, the purposes of your new coalition?
Yeah, absolutely. And thanks for raising it. So the coalition is called the Coalition for Financial Ecosystem Standards. It's a group of really some of the largest fintechs out there. So the public ones are Stripe, Brex, Treasure Prime, Square, Block, Row, and a few others. I think the membership is up to about a dozen now. And so the idea was that there is really a gap in the industry. So all of the partner banks that these fintechs work with are the regulated entity. They then by contract tell the fintech that they need to be responsible for some of the compliance and risk management activities that the bank would otherwise be responsible for, right? So they're kind of outsourcing it to them. But when they outsource it to them, they're not necessarily saying you have to adhere to the same exact regulations that we have to adhere to as the bank. And sometimes they do. Sometimes they point to the AML guidance and other laws and say, hey, you should follow that the way that we do. But there's a weird mix. Sometimes there's a program manager involved. Sometimes the bank does a little bit of it. FinTech does a little bit of it. And ultimately, the bank adds its interpretation to the law when it oversees the fintech, right? So it says,
Mm-hmm.
fintech's based on, or AML's based largely on best practices. The bank is going to kind of take what it's hearing from its examiners and what it's hearing from the industry and then kind of push that onto the fintech. And what we found is that when the fintech is undergoing all these activities and taking on all this work and they're bringing it back, proving to the bank that they're doing a good job, and then the bank takes it and they hand it to the examiners and say, look, we're all doing the right things. It's not creating a very convincing story.
Mm-hmm.
It's a lot of word salad. It's not particularly well organized. The examiners have a very hard time understanding exactly where that fintech is in its journey to have a strong compliance and risk management program. And as we started thinking about it more, what I realized in having kind of sat, next to or near banks as they've gone through some of these examinations, was that there were some areas of compliance or risk management that the examiners had a good grasp over the maturity of that fintech, specifically SOC compliance. The bank could say, this company is SOC 2 Type 1, but is going to, by contract, become SOC 2 Type 2 within 6 months of launching this product. Or this fintech already is SOC 2 Type 2. Or this fintech has PCI compliance, or is PCI compliant. And the examiners were largely able to understand and evaluate whether or not that was good enough based on the risk. But then it would come to like they'd be reviewing AML, for example, and they'd say,
Mm-hmm.
well, here's the AML audit for this big fintech. Here's the AML audit for this small fintech. And guess what? The auditor has picked out like a few things from each of
Right.
them to critique them on, but there's no way to really like evaluate what's a really strong, robust, well-tested, calibrated compliance program and
Right.
one that's like largely just a few policies and maybe a tool.
Yeah, I'm
So
always amazed that I'm a former CPA, and having grown up in that audit culture where there are the very rigorous AICPA and PCAOB standards. There's like a peer partner review. There's peer firm reviews. There's extensive work papers and like audits routinely run in the millions of dollars for public companies. And then I've talked to some AML compliance professionals who will provide the annual AML audit for $500, $1,000. And I'm like, how is that possible? And like, look, they stand up to the scrutiny that regulators apply in many cases, depending on the type of business. But I've always been amazed at the lack of an AI CPA equivalent. That I know there's ACAMS, but it just has nowhere near the uniformity of public accounting.
Yeah. Yeah. So that's actually part of what we're trying to do. So what we have is we have the standards, and then we have a rating system for each of the standards. It's a 5-point scale for every single standard. And we've been working across 6 different areas so far, including complaint management and ops risk and third-party risk management, marketing, and BSA AML. And so we've created like a scale of what is a really amazing program or control for one of the standards, and what's like a pretty basic one, like designating your CEO as your compliance officer. Like, yes, I guess that meets the definition of having a designated BSA officer, but it's not a very good solution. And so all the way to having a very good BSA officer and a team, and somebody who has received ACAMS training and is well supported and has a budget and has the right tools. That's what a good BSA officer setup looks like. And so within every one of the standards, we actually have that, and that's what we're working on with the members right now. Is let's put in a lot of detail of like what is a 1 through 5, with actually 1 being the best, 5 being the lowest level of certification, so that we can actually, in banks and regulators and fintechs, can have a conversation the same way that kind of SOC 2 Type 1, SOC 2 Type 2 creates a nice conversation. The second part of this is a certification process that is kind of heavily controlled. So the coalition will designate firms, will review the firm's work, and anonymously, of course, to protect confidential information, but to make sure that the firms are rigorous and that their certifications are aligning with what other firms are doing, in the level of scrutiny that we really expect the certification process to have. And so that's part of it, right? So that only some firms will be able to meet this. If the work product isn't great, if they're essentially giving people ratings that they don't deserve, like the
Mhm.
coalition wants to control that.
Yeah. Yeah, I
So,
think a
but it's
great
still,
model of that that's worked well has been with PCI DSS, that they have the external, like they have the external reviewers who have to themselves meet standards for their review quality for merchant and other adherence to the PCI DSS standards. And I have to say, while I love fintechs, I work with fintechs. I always have like a little cringe when I've seen other types of industry initiatives where it's very heavy on the aspire and intend and will strive toward, because that's obviously the lowest common denominator. That if you're an association who wants to grow your membership as quickly as possible, you don't want to fail or exclude anyone. Like that's counter to your point. And so your standards would be things like, oh, well, people will work hard to have positive customer results, and like it won't say things like, well, if your customer complaint resolution time is over X, or if your volume is over Y, then you fail. But when you look at the card networks, like they're very clear, because they don't have that same incentive. That if you go to the card networks, they'll say, look, if your chargeback rate is over such and such, you fail. And that kind of hard conversation, I think is a really important thing for the fintech sector to get on board with. That not everyone can be a winner.
yeah, that's right. And we have hard conversations all the time as part of this group about, oh, does this kind of benefit the more mature fintechs? Will they get that? Will they receive the higher ratings? Well, potentially, right? Because they have many years of kind of investing in operational maturity, but it won't necessarily, just because they've been around, necessarily mean that they get all ones, right? Like they're
Hmm.
they're going to have a lot more volume, hence a lot more things may fail or break. And as we've seen, there are some big companies out there that still have compliance issues. So I don't necessarily think that they will always receive the top scores, but there are things or indications that the certifiers will be looking at to determine whether or not they have a robust program and they've made the right investments. And some of those things just come with age and maturity, like having validated transaction monitoring rules as opposed to things you just picked, when you started
Mhm.
the company 5 years ago. And so, those kind of things like early stage companies won't have. But as long as we make it very clear, kind of like SOC 2 type 1, SOC 2 type 2,
Mhm.
I've never heard of a company say, oh, I should have been SOC 2 type 2, but that auditor really just really treated me poorly. Like that just doesn't happen. People know I haven't made the investment yet. It's hard. I'll get
Mhm.
there at some point. We'll do it. That's how we want it to look and feel, right?
Mhm.
And so that's where the members right now are working on, like, how do we create these different levels within each standard that's a very clear, like, yes, I know I'm a 3 today.
Mhm.
Next 6 months, I think I can get to a 2 if I do these couple of things.
Right. Yeah. The other one I remember is I've seen some of the AI groups out there that they create these continuums of AI competence of like one being the most basic like chat bot and five being like general AI, artificial general intelligence and I always somehow regardless how every startup is a five and you're like like I still am typing my own letters. There's no way that every vendor on the market can be a five on that scale, and I'm still and you're right. It is that goal of getting it, but I think it having a real rigorous system like you described with actual defined standards and ranges of scores, it also will help some of the banks that are facing these non-bank partners that one thing I often hear is that the regulators believe there is really no bank that is good enough to bank fintechs. And there have probably been 20 plus banks who I've seen forced out of banking on like a banking as a service or bank partner program, however you want to characterize it. And from the banks that I've talked to, it's been yes, we grew too fast, we onboarded too many, but we had to because the only way we could justify the spend on this new business line, or the only way we could be competitive for our investors was doing it. And I think this will give banks like some criteria to if they want to grow in a, I won't say accelerated because that would still be bad, if they want to grow in a moderate pace, as opposed to like just having one or two fintechs, maybe if they wanted to have like six partner banks, these kinds of external validations are helpful for picking, well, which are the six I want to deal with.
Yeah, that's a really good point. And so, while we don't have banks as members of the coalition today, we're obviously staying very close to them and have included Alloy Labs as part of a kind of an advisory group that we're pulling together so that the banks can opine on how they would utilize these scores as part of their program. Ultimately, it's the regulators and the banks who need to decide how they want to leverage these ratings the same way that they've decided how they want to leverage audits that they've ordered. There's no kind of regulatory requirement for fintech to go receive an AML audit each year, right? It's just
Right.
something that the original partner banks kind of made up to try to keep their regulators happy. Probably the Utah, like ILCs back in the day, said, "Hey, you should do
Right.
an annual audit because we do an annual audit and we are outsourcing some of this compliance to you." And so the banks and the regulators will have to kind of make a decision on how they incorporate this into their program. Does it replace audits? I'm not really sure, and I'm not convinced it needs to in the short term. Does it create a common lexicon so they can have better conversations around the operational maturity of their fintechs? It definitely does, and I think that will be really, really helpful um, in kind of improving the outcome of some of these exams. But You mentioned something really interesting, which is this like dilemma that every small community bank that is involved in partner banking has, which is like it doesn't really move the needle if you have 2 or 3 programs.
Hmm.
Does it
Right.
start moving the needle when you're at 20? Yes, but if there's a couple bad uh, fintechs that are either struggling or just like not listening to you, like it can get out of control pretty quickly. And 20 fintechs is a lot. Like there's a lot of activity going. They're changing their products quite frequently. They're coming up with new marketing every day. Their systems are going down from time to time. So there's a lot of things you have to pay really close attention to. And so a bank with 20 fintech programs is a very busy bank.
Right. Right. Well, I think this has been a very busy and enjoyable conversation, that there's been a bit of something for everyone in here. I've always been impressed with FS Vector's work on the non-bank side, or on the bank side, sorry, the uninsured bank side. And you certainly have been able to allay many of the concerns of the banking regulators in helping your clients navigate it. So I am hopeful for your work with the coalition and getting it off the ground. And we'll probably have to do another episode out there once the coalition starts getting some broader acceptance, and there's some track record that we can talk about how it's been performing under these standards. But until then, I want to thank you so much for being on the program today.
Thank you so much for having me. It's been fun.
Yeah. I want to thank our listeners as well. Without you, we wouldn't have a reason to do these programs. Please tune in for the next episode.